Assalamu alaikum everyone. Today I'm going to explain an important accounting topic which is the sales return cycle. In this presentation we will learn what sales return is, why it happens, how the sales return process works, and what accounting entries are recorded. What is sales return? Sales return means when a customer sends back the goods to the seller after purchasing them. This usually happens when the goods are damaged, defective, or not according to the customer's requirement. And in accounting, sales return is also known as return inward. Sales return reduces total sales and also reduces the customer's balance. Here are the reasons for sale return. There may be many reasons for sale return. For example, the goods may be damaged during the delivery, the wrong product or the wrong quantity may be delivered, the delivery may be late, or the customer may not be satisfied with the quality of the product. And in all these situations, the customer has the right to return the goods. So, here is the main topic: what is sales return cycle? The sales return cycle is a part of the revenue cycle. It starts when the customer returns the good and ends when the company either issue a credit note or gives a cash refund to the customer. This cycle is very important because it helps the company record return goods properly in the accounting system. So here are the steps in this sales return cycle. The sales return cycle has 5 main steps. The first, the customer return the goods. Second, the goods are received and inspected. Third, return is approved by management. Fourth, credit note or refund is issued. And finally, accounting entry is recorded in the books of accounts. So moving to the first step, customer returns good. In the first step, the customer sends goods back to the company along with the goods. The customer usually submits a return request and provides the original sales invoices as a proof of purchase. This helps the company verify the original transaction. So here is the second step, receiving and inspecting goods. In the second step, the return goods are received by the warehouse or store department, and the staff checks the quantity and the quality of the goods to make sure that they are in the same items that were sold. After inspection, they decide whether the return should be accepted or rejected. And here's the third step, return approval. After inspection, the return is approved by an authorized person, usually a supervisor or a manager, and the return note is prepared. And if the goods are in good condition, they are added back to the inventory. And this step is important to control wrong or fake returns. Here is the fourth step, credit note issue. In this step, the accounts department prepares a credit note and sends it to the customer. This credit note reduces the customer's outstanding balance. If the customer has already paid in cash, then instead of a credit note, the company prepares a cash or bank refund. Here is the fifth step. Finally, the accounting entry is recorded in the books of accounts. Uh, the sales return is debited because sales are reduced, and the accounts receivable account is credited because the customer's balance decreases. Inventory is also increased because the return goods come back into the stock. So here is the journal example of when the sales on credit. Okay, uh, let's understand with this example. Suppose a customer returned goods worth 5,000 rupees from a credit sale. In this case, we will debit the sales return account and credit this accounts receivable account. This entry reduces both sales and the customer's balance. And here is the journal entry example when sale is on cash. Okay, if the original sale was on cash, then the entry will be different. We will debit the sales return account and credit cash or bank because the company is returning money to the customer. So here is the impact on the financial statements. Sales return affects the financial statements in many ways. It reduces net sales in the income statement, which also reduces profit. It reduces account receivable in the balance sheet. It increases inventory because the return goods come back into the stock. So here are internal controls in sales return cycle to avoid fraud and mistakes. Companies use internal control in the sales return cycle. All returns must be properly authorized. Proper documents such as return notes and credit notes should be prepared. Uh, Different employees should handle receiving goods and recording entries. Management should also regularly review sales return reports. Uh, to conclude, the sales return cycle, this is important as we know that this is an important part of the revenue cycle. It helps the company record return goods correctly, reduces sales properly, mm, and maintain accurate financial records. A strong sales return system improves reliability of financial statements. So thank you so much for listening. Have a good day. Goodbye.